The recession that everyone was worried about at the beginning of this year is finally here.
Another dismal day on Wall Street, really disastrous, actually.
Homelessness in Riverside County is rising at an alarming rate.
The Federal Reserve is set to make it more expensive to borrow money.
The recession is not coming. The recession is here.
Inflation and economic stagnation have caused food and energy prices to rise, and they are expected to increase even further.
This morning, with inflation already at a nearly 40-year high, a new sign that prices for many everyday household items are set to increase even higher.
Despite the efforts of the Federal Reserve to prevent an economic crisis, they have not borne fruit. Several economists predict that a recession is imminent.
We think recession is inevitable by the end of the year.
But here's the reality of the situation. I think the recession's already begun.
The Richcession, as some economists call it, has begun. But for now, it's only affecting high-income individuals in America. Persistent inflation and a weakened stock market continue to disproportionately press on wealthy Americans as an increasing number of high-income individuals file for unemployment.
It might seem like Fed Chairman Jerome Powell's view of the labor market doesn't jibe with the layoff after layoff after layoff that has plagued the tech industry.
According to Bank of America, the primary engine of wealth creation and destruction in the world is the stock market. So if it's doing well, the economy does too. However, when it's doing poorly, it tends to wreak havoc on the economy. So, why should we be concerned about this recession? And how will it affect middle and lower income Americans? The wealth effect is an economic term that encompasses the value of assets and consumption. When there is a decrease in consumption, combined with a decrease in the value of assets, it causes the economy to stagnate. Given that the U.S. economy relies primarily on consumer activity for its growth, this results in a fragile economy and at times a recession. To understand how this recession of the wealthy happened, let's go back to 2022. The stock market crashed and housing prices began to drop at an alarmingly rapid rate. Simultaneously, the tech sector was declining, causing the prices of almost all assets to start falling, thus affecting the household economy in the United States.
Some disappointing earnings from big tech so far. Alphabet, Meta, Tesla, all slumping since their respective prints.
While prices and the economy have moderately recovered in 2023, they have not returned to pre-recession levels. Many of the problems that were present in January, such as inflation, high interest rates, and high prices of basic goods, still persist today.
Jerome Powell has told Congress the fight against inflation still has a long way to go.
Regardless of the country's economic situation, many Americans feel the pain of inflation and high living costs, as even the rich are depleting their savings and resorting to credit cards to survive in an increasingly challenging economy. Recession fears have hindered the white-collar job market, with a 40% decrease in job offerings in banking and finance compared to the previous year, and a 50% decrease in tech roles. The country's most prominent tech companies are laying off thousands of employees, and that number keeps growing.
Today joined a growing list of tech giants scaling back, adding to the tens of thousands of workers in the industry who find themselves unemployed.
Microsoft is cutting 10,000 jobs, and Alphabet, Google's parent company, is reducing its workforce by 12,000 jobs. This follows other significant job cut announcements by Amazon and Salesforce earlier this month. But this situation is not limited to tech companies.
Wells Fargo laying off hundreds of mortgage bankers this week as part of its strategic shift.
100 Wells Fargo employees are expected to be laid off by June of next year.
Wells Fargo is one of the banks that has laid off the most employees this year, with a staggering number of around 11,000 employees. Or, in other words, Wells Fargo has fired nearly 5% of its entire workforce. Similarly, Saks and other financial institutions have been affected by high interest rates, leading to excessive staff cuts. According to UBS's Global Wealth Report in 2023, nearly 1.8 million millionaires lost their status, mainly due to the stock market's abrupt fall in 2022.
The S&P 500 and Dow closed lower on Wednesday on the prospect of more interest rate hikes.
The S&P 500 fell by around 19% in 2022. Thus, there has been significant economic uncertainty among high-income families since then, as they have become more cautious about spending. Factors such as low wage growth and a lack of new job opportunities are linked to the rise in unemployment claims. Some higher-income households have significantly tightened their budgets and turned to credit to fill the gap. Household debt has increased, particularly credit card debt, which has exceeded $1 trillion, even though higher-income households are only purchasing essential items. This complicates the situation further for high-income households. Despite the summer rebound in 2023, the stock market is being affected by rising bond yields and the prospect of higher interest rates for a longer time.
We're in the middle of what some are calling a historic time in the history of U.S. government bond pricing.
U.S. 10-year yields, they are climbing towards their highest level since the financial crisis.
The stock market could remain weak for a long time due to these high interest rates, which means there won't be much wealth creation. If high-income individuals stop spending, companies that rely on the spending of wealthy individuals, such as luxury real estate, luxury fashion, yachts, airplanes, and more, will be affected and experience slower growth than usual. In the second quarter of 2023, all luxury companies experienced something unprecedented since the pandemic, a decline in sales in the United States.
Shares in LVMH fell 5% on Wednesday. Investors had become well used to strong results from luxury fashion brands in recent times.
We are at the lowest level now since the back end of last year after the company produced third quarter sales numbers where we saw a drop in demand.
LVMH, a giant that always succeeds, reported a surprising 1% drop in sales in North America. Similarly, Richcession, the owner of Cartier and many other brands, reported a 4% drop in sales in the United States. Nearly 20% of high-income Americans account for more than half of all spending in the country. Those with more money spend more and have contributed to the economy in the last 30 years at a time when the middle class has lost ground. Investors now face two major obstacles: market uncertainty and a lack of visibility. Uncertainty refers to not knowing where the market is heading, which leads to a lack of visibility into potential future investment opportunities. Consumer spending is a significant driver of economic activity, so when the rich stop spending, they can slow down the economic recovery across the country.
Americans crimped their wallets last month as inflation heated up to historic levels. The Commerce Department reported Friday that consumer spending, which accounts for more than two-thirds of economic activity, dropped 0.6%.
Now, despite everything seemingly being against the wealthy, a UBS report projects that the rich will get richer over the next decade. Global wealth is projected to increase by 38% in the next 5 years, reaching $629 trillion by 2027, and it's estimated that the number of millionaires in the United States will grow to 86 million, compared to 59 million in 2022. A recession in the United States, along with a stock market that potentially underperforms, could create the right conditions for America's wealthy to recover. What wealthy investors will do is put their money in safe investments and wait to see if the economy falters. If we end up in a recession, these investors will have the capital to buy other assets at low prices. There's an old expression that a recession is like a garage sale for the rich, as it's the time when many wealthy investors buy assets at low prices, ultimately increasing their wealth over time as they recover.